All right, guys, so we're going to go ahead and get started here. Today we are going to be discussing the misconceptions, misperceptions on options in general. So obviously, the reason why you guys are here is because you want to be able to trade profitably in options. There's probably a whole bunch of mumbo jumbo out there that is sent out to the retail guys to kind of, put you off from actually trading options and making it sound way harder than it really is. Well, it's still difficult. There are ways to really simplify the process, and we're here to make sure that you understand at least the basics of things that you should probably ignore a little bit more, and possibly things that you should also pay attention to a little bit more. So without further ado, we also have one of our partners. Again, my name is Pete. I'm the risk manager guy over here. Lucci is on the other side. He's also here as well. And I've also got Charlie, who is, our fancy smancy professor on the blog, as well as our operations guy. So before we get in here real quick, Charlie has a few words to say for you.
Hey guys, what's up? Yeah, as Peter said, this is Charlie. I work with these two animals. I don't know what you want to call them. But we get a lot of requests to give better descriptions and more in-depth explanation of our courses. So we just wanted to give a quick rundown here for a couple minutes about what our courses are, what we offer, and what you're going to be getting into. So I'll just scroll through this real quick. Let's go through that, Pete. See, this is why you got to have guys like Pete around. Okay, so so the main course that we offer is our most comprehensive educational product, and basically it's a 12-session course. It is taught 3 nights a week for an entire month. So Monday, Tuesday, Wednesday nights, we start at 8 o'clock. We usually end around 9:30, and that is Pete and Lucci teaching you for an hour and a half every night for 12 sessions. The next session starts on Monday, February 18th, so that is this coming Monday. I mean, you get a lot of stuff that comes along with the classes. I'll dive into a little bit about specifically what we teach in a second. But sort of the additional add-ons that we give you 1 month access to the permission-only private Sang Lucci chat room. This is the room that Lucci has been cultivating for the last 2 years as an options trader. Some of the people who have learned his strategies from the beginning and who have become very successful, very strong options traders are in there every day with him. It's sort of his private crew, and we use that for information sourcing throughout the day for our trades, as well as discussing different strategies and such. And so you will have first-hand access to that for a month for free to really reaffirm on a daily basis what you've learned in the classes. You also get 1 month access to the video library. There's over 10 hours of content in there, ranging everything from, hey, what's a put and a call, to this is an advanced options play that Lucci and Pete did using tape reading, advanced options strategies. They break it down using visuals of the charts of the trade that they did. So we have people, our more dedicated students definitely spend a lot of time in there, and it really helps cut down on the learning process for that, for options and tape reading. We also give lifetime access to classes. So I think this is actually our most popular element of the classes. If once you pay once for one of our classes, you can come back as many times as you want. So in the February session that's starting this coming Monday, we're going to have people from October, November, December, and January in there. They've just kind of become a part of our community. They're in there every single day, every single night. They're asking really good questions, which helps us teach the new students even better. They're constantly giving us feedback on what we can improve on, which is always something that we strive to do. We record each class, so we have people who are international. We have people who happen to work on a Tuesday night. We have people who have families and kids, and their lives are unpredictable. We record each session, so if you miss anything, you want to go back and review it, we give you a recording of it. That's not a problem. We also give you our 80-page digital course guide. So this is something that Pete, Lucci, and I slaved over for 2 months. Quite honestly, it was a miserable process, but we made this thing for you guys so that you can have sort of a textbook to take you through everything that we're teaching. And if at night you want to go through and kind of reaffirm everything that we've taught, then that textbook is there for you. Specifically, we break up the course into 6 sessions. So if the first night is trading basics. If you don't know anything about trading, that's okay. We're going to take you through the basics of what you need to know about trading. So looking at charts, candles, stuff like that. It's just the basics, but we want to make sure you're covered on that. The next one is trading options. So obviously we specialize in options here at St. Lucci. Pete and Lucci are going to take you through everything from basic options like puts and calls, sort of definitions and strike prices, not in the boring academic ways that you're used to hearing them, but in a way that you can actually understand them and put them to use. Then they start going into more advanced option strategies and the kind of stuff that they put to work on a daily basis. The next thing is tape reading. So this is really one of the things that differentiates us. This is how Lucci really made his big strides as a trader when he was at the prop firm. Tape reading is watching supply and demand shifts in the market in real time. So watching buyers and sellers acting in the moment and understanding, making short-term price predictions based on what those buyers and sellers are doing. This is really what differentiates us. So we teach you the fundamentals of tape reading. After that, we give you the St. Lucci method, and this is what we like to say as this is really what you guys pay for. This is what Pete and Lucci do on a daily basis, trading the hedge fund that we manage, trading, getting the kind of gains that we had today, like the $65,000 gainer in Citigroup. This is how we do it. We don't hold anything back. It's not like we're keeping some secrets for us, in the background. This is what we give you. We give you the full thing. And then we wrap it up in the last 2 nights. We give you trading platforms and brokers. A lot of you guys are out there really getting smashed on commissions, or you're using a platform that's inhibiting your trading and you don't realize that. We want to make sure that everyone is using technology and getting the best commissions that they can get. That's a huge part of being a trader. And then trading psychology is really laced throughout the entire course because any good trader will tell you that once you really get the fundamentals down, trading is all psychological. It's all a mental game. So, but in the last class, we really do hit on trading psychology. So, real quick, guys, if you guys want to take advantage of this, tonight we are running a special for you guys, just to show appreciation for showing up to the webinar. You just go to this website, so marketfi.com/product section, Lucci options training. I'll put that in the chat, so don't worry, you can click on that. You type in the coupon code Lucci options, and that will get you $750 actually off the asking price for the class. So instead of $2,500, the class is $1,750. That expires tonight at midnight. We do know that a lot of people like to do payment plans. We don't currently have a payment plan option set up on MarketFi, but we do offer that for you guys. So if you want to do a payment plan, all you have to do is just type into the chat payment plan, and whether you're interested in it or whether you want to do it, doesn't matter. Just type that in, and we'll contact you. We'll make sure you guys get the information that you need. And yeah, I think you've heard enough from me. I'll hand it over to Pete and Lucci.
So appreciate that, Charlie. So without further ado, we're going to go ahead and jump into actually, since we were able to make a pretty nice trade today, Lucci himself is actually going to go ahead and talk a little bit about the actual trade. Give me 1 second, and I'm going to make him the man to watch here. Here we go. Go ahead, Lucci. The floor is yours.
Okay, guys, can everybody see my screen here? Just making sure if everybody can see it.
Yeah.
Okay, great. All right, so let's go ahead and get into some juicy shit. Again, let's do the disclaimer here on the swears. If you guys don't like swears, I would suggest you get the hell out of here. So let's do Citigroup and this Bank of America.
Lucci, get a little closer to your mic real quick.
Is that, what's that, Pete?
Get a little closer to your mic. It's a little soft there.
Okay, does this sound a little better?
Yep, that's good.
Okay, great. Apologize for the technical difficulties. We are all in different places right now. So, take a look at your monthlies on Bank of America and Citigroup. You notice they haven't done anything for like a month. And Goldman Sachs and JP Morgan, they've kind of been trending higher. Obviously, this Goldman has been the most bullish one out of the pack, while this Wells Fargo, Bank of America, and Citigroup, they've kind of just sat in this big range for like a month. And it was difficult to find the break point here. And if you notice, like, you guys hear me on Twitter, I've been waiting for this to happen for quite some time. And you guys remember last week, we were all pretty heavy, those 12 weekly calls that expired last Friday. So that would be February 8th. So a lot of us were pretty heavy on those 12 weeklies. They went from like 2 cents to maybe 10 cents. And we had a couple of days where it looked like they were going to break through, but then it just kind of gapped down the next day and just kind of did nothing. So those options ended up expiring worthless. And yesterday, too, it started picking back up towards 1180, 1190, and then this morning, I mean, that's when it all kind of came to fruition. And notice you didn't really have that long of a time. You didn't really have that long time to get into this trade and actually build the position size that you want to. So I was very frustrated at myself because I hopped in. I mean, I hopped in when I needed to, but I didn't get the size that I wanted to get until this consolidation. So basically, I made a decent chunk of money here in the Bank of America 12 weeklies, and then also the Citigroup 43.5 weeklies. But I wasn't able to just go ahead and buy the amount of size that I wanted to. So I waited until this consolidation, got pretty heavy on this move in Bank and Citigroup, and then caught the second leg higher. So you can take a look at these charts here. These are all options charts of the options that I played. So if we take a look right here, this is the 43.5 Citigroup call. I bought this at like 30, 35 cents. I think I had like 500 contracts, and then I sold it like 63 maybe some at like 55. So this was a very quick move. And another thing I want to reiterate here, guys, is that they do so well at making sure that the least amount of people are in these trades when it actually happens. You guys realize these things have been doing nothing for a month, okay? A month. And then yesterday we had all this light volume on the SPY, and then today we got light volume too. But all of a sudden they chose today as the day to break out on all the banks, which is kind of ridiculous to me, but it is what it is. So this is the option that I kind of got heavy in when the consolidation happened. So I was starting to buy, 45 cents. I had an average cost of about 45 cents, and I had about 1,000 contracts. And I was able to sell, up to 65, 65, and I had a couple at 70, 68 as well. And the Bank of America, which you can see right here, this option was pretty aggressive. I started buying at 9 cents in the morning, and then dumped it like 12, and then a little bit at 13 or 14, and then just started buying all this consolidation here. I had a cost of about 18 cents, and I had about 4,000 contracts, Pete. Was it 4,000?
Yeah, total 3,500
4,000.
until the last bit, and then 4,000. Yeah.
Yeah. So then what I did was I started selling, at 23, 24, and then we got this big spike up. I sold, 30. I sold the rest of it at like 32.
These were
big trades, guys. What'd you say?
I said we top ticked it at 34. Actually, I think we saw some sells.
Okay, well, we top ticketed here, but it ripped at the end of the day. But again, you guys see the you guys see the potential here. Citigroup is crazy, Wells Fargo was crazy, Goldman Sachs was crazy. There was a lot of money here, but again, I want to emphasize how quickly you lose that solid premium. Okay, you guys need to have that conviction to buy as many as you can, when that breakout really does happen. But they do so well in making it happen very, very quickly. Anyway, so that was the trade here. We made a good, 60, 65,000 on it. Not as good as I wanted it to be, but again, I'm still working on developing the ability to get more size when I do have that kind of conviction and do it a lot quicker. Because again, this market happens very quickly. You got to adapt real quickly. So that's the trade of the day. But let's go ahead and talk juice about what we actually wanted to do this webinar about, which was some of the misconceptions here when it comes to options. Okay, now back in the day, right? I started this chat room 2010. Right? So I started it like 2010. I started, blogging and all that kind of stuff. I was blogging from before, but I never really had a chat room. So I had this chat room, right? And I would have all these guys come in here, and they would all ask me these questions about how do I use options. And they would bring to me questions and stuff that their professors would say. I had a lot of college kids, So we'll get a lot of college kids in the chat rooms, 19-year-olds, 20-year-olds, and these guys are taking investments classes, right? So in the investments classes, they teach you about options. And they would come here to this chat room, and after speaking to their professors about some of the trades that I would make, and oftentimes their professors would say, no, this guy's an idiot. This guy's crazy, and he doesn't know what the hell he's talking about. And one of the the largest misconception, I would say, about options is that you have to hold until expiration. Okay? A lot of these professors were telling their students, like, okay, at the end of expiration, or wherever the expiration is, if X, Y, and Z stock gets to a certain level, you go ahead, you can make money. Then you make money in the trade. Okay? And this was a huge misconception, and I knew that none of these professors were actually trading any of these options. I knew it. I knew it. And I would tell this one kid, I told him to tell his professor to come to my chat room so I could light his ass up, so I could tell him, hey, listen, this is not how it is. You are teaching them you're teaching them incorrectly. You yourself don't even use these options. So he comes into the chat room, right, and I have to sit here and explain to them, or explain to this guy, that these options are valued differently every single day, every single hour, every single second. So just like you have your equities charts that are going up and down by the second, you're going to have your options charts which are doing the same thing. And I want to go ahead and show you an example of an Apple call 550, and this is out in May, okay? So let me go ahead and give you this example here. So let's say a lot of you guys are harping on Apple. Like a lot of you guys are thinking like, okay, Apple's going to be a huge move to the upside, right? How do we play this? Okay? So let's just do a quick example here. Let's take a look at Apple. And how would you want to play this? Let's say, okay, you're taking a look at this long-term chart, and you see the big tank, obviously, from $700. And you say to yourself, okay, she's going to spike up, and I want to go ahead and make money off of it. So you buy a May 550 call. Okay, and let's see what you pay for it. Let's see if you bought it now, what would you pay for it? So you would pay, it closed at around $5.50. Now, here's one thing that people don't understand. They trade as often as stock does. Obviously, it's a lot more illiquid, but they fluctuate in price every single day because of what's going on in the stock. So the stock took a 10-point dive today, and this 550 call in May went from what? 750, 775 at the open, all the way down to $5.75. Okay? So if you're long this option from $7 and whatever, $7, $7.50, and it goes down to $5.50, you're down $2 per contract on your option. Okay? So let's assume that this stock goes to whatever, $5.50. Okay? And let's assume she goes to $5.50 by next month. All right, by next month. And can you sell out of this option for profit? Absolutely, because options is about perception on a particular strike price. Okay, so as your stock gets closer to your strike price, people are willing to pay more for that perception that the stock is going to go through that strike price. And remember, you got this until May. Okay, there's expirations involved, so you got 3 months here for this stock to make a move. And if it does that, if it does make the move that you're looking for, people are willing to pay more for this option, and therefore you can sell it to them for a much higher price, higher than what you paid for. Okay? So if you bought this for $5, let's say stock goes to $500 tomorrow, obviously people were willing to pay $7.75 for it this morning when the stock was what? At $4.80. At $4.80, they were willing to pay $7.75 for this. So if it goes to $500 tomorrow, how much do you think they're willing to pay for it? Probably $10. So you go ahead and buy it 5, and you can sell it at $10 tomorrow for a profit. You do not have to wait until expiration. This is a big misconception about how to play options, and again, stuff that you will learn in your investments class. And again, people that supposedly know what they're talking about here with the market, how to use options, they fluctuate in price just as much as the equity does. And it's very important, again, to watch what your equity is doing and to understand the overall perception in a particular option, which is, again, one of the big ways we teach how to price options, how to look at options, and how to play them, which you don't really find on the street because, again, there's that common rhetoric that everybody has that I feel like the game has changed a lot, and we kind of explain it in a more dumbed-down fashion, just so everybody can understand it from a common sense perspective. So I'm going to throw this back over to Pete here. And Pete's going to finish up on some of the other misconceptions about options.
Thanks, Lucci. So, guys, hopefully you guys were able to catch that pretty awesome trade today. If you guys don't believe it, here it is. Here's the P&L. We actually, Lucci, we got a call from our brokers a little bit about the price line nonsense. So, I'll talk to you about that a little later. But sometimes, guys, so we're going to just kind of get into the nitty-gritty on some of the more, I guess, executable things in options that a lot of people have issues with. Okay. So one of the big things is that options are only used for hedging equity positions. a lot of guys out there think that, if they're long something and that it's going down, maybe they can sell calls against it, all this kind of stuff. And that's doable. That's understandably a way to protect your investment. It's definitely something you can do, but there are risks that come along. For instance, this is KERX. Okay, I know a lot of you guys out there probably play pennies, probably play the farmies, and this is actually, I believe, it's a real company. And a lot of times you'll get these weird supernova moves, and what happens is that if any of you are actually trying to protect your positions, meaning from downside action, you can actually tank this stock yourself. All right, I actually know of a couple players that were buying puts while I was up here, and this thing does not trade a lot of options. So a lot of times what can happen is that by you trying to mitigate risk on some of your portfolio holdings, you're actually dampening the effect on that stock, okay? And another topic that we'll get into a later time is that even though in academia they teach you that the equity is what determines an options price, it's not really like that in practice, okay? You can move the price of your equity through the options. That's just one thing we want to make sure you understand, that when you're mitigating risk in a long-term holding that you have, that you understand the underlying factors that go into the actual position itself. You have to understand what the float is. You have to understand how many shares it trades. You have to understand what strike prices are the big ones. And that's very important to understanding how you're supposed to mitigate risk on long-term holdings. Not in addition to that, you can use options also to enhance the returns on your actual longer investments, and that goes into the misperception of options are much riskier than equities. Okay, so yes, there are a bunch of factors that go into equities, and there's a bunch of factors that go into options, and there's even more into options that come in terms of volatility, in terms of time decay, kurtosis, and all these fancy terms that you can go into that make it seem extremely daunting. All right, but what you have to understand is that options allow something very inherently powerful, which is the exposure properties of it. One contract exposes you to 100 shares. Without the outlay of putting out $50,000. Instead of throwing $50,000 out there for 2 cents to 20 cents on a trade where you make maybe 1% of your gains, that $2 or 2 cent to 10 cent move on your underlying could possibly mean that you can make a trade just like today, where you buy an option from 9 cents and sell it at 30 cents. Okay, and the best thing about it is that unlike in equity positions, especially in a short environment, you don't have to put that much cash on the line. Okay, and just to emphasize that, we'll talk about just a short example. So this is something that we teach in our class. Again, guys, if you want to check it out, check out that link that we have to you. Charlie is answering all the questions in terms of the classes. So say you were going short. Okay, if you guys understand what going short is, this is doing something where you don't have the money, you don't have the actual equity itself. Okay, so when you're going short, theoretically, you have unlimited downside risk. Okay, stocks can go up infinite numbers, okay, to an infinite amount, but they can only go down to zero. So going short inherently is, one, more difficult, two, requires you to borrow something. Okay, you borrow shares from your broker, and that inherently could cause a lot of weird risk to come in. All right, instead of doing that, what you could possibly do is just simply use a put. Instead of using $200,000 in margin or $50,000 in margin, what you could do is you simply buy 5 puts, and these 5 puts could generate anywhere between 10 to 20 times more money than that actual equity position. And again, this is just one thing for you to understand about how options, although they sound more risky than equities, that there's actually a way to mitigate that risk. Okay, especially if you are new to trading and that you're still working on your timing, you're still working on averaging in positions. Every dollar matters to you. Every $100 matters to you, and for us, every $1,000 matters to us. And the best way to mitigate some of this risk is to be able to diversify it across in options. Okay. Another big misperception is that even though that there's a inherently less risk because you don't have to put so much money on the line, doesn't mean that the option is not risky at all. Okay, it doesn't mean that your option is going to give you more reward for less risk. Okay, it's actually going to, the intraday movement of options is going to scare the heck out of you. Okay, and that's just the honest truth. Okay, because when your equity moves down 2 cents, you may only lose $50 at that time, but your option you may lose $100 to $150. Okay, and that's inherent to the actual movement of the option. But again, these are two different factors. One is your initial outlay, which just determines you're putting $500 down, and the return you could get on that could be another $500. Or two, what you have to understand also is that the movement of the option is going to scare the heck out of you, so you're going to have to really be able to maneuver around. And that sort of brings us to the next point of, everybody across the street is thinking, oh, I want to mitigate my risk when I'm trading options, therefore, so I can use this much buying power for this, and possibly go into some fancy option strategies. So I'm just going to move this over. This is from freaking Investopedia.com. This is the most basic stuff you can get. All right. I want you guys to just start looking at this. Okay. We're looking at bull call spreads, bear put spreads, protective collar, straddles, long strangles, butterfly spreads, iron condor option strategies, iron butterfly option strategies. There's even a broken wing iron butterfly. All this kind of stuff out there. And this is incredible that people actually teach that these are the real ways to trade options. And I mean, I understand that these are viable option strategies, but do you guys have $500,000 lying around to execute 4 different legs into an option strategy just to capture 20, 30 cents? Yeah, I don't know. Maybe you do. If you were, I wouldn't be in here with us. And also, like for a lot of retail guys, this is 1, 2, 3, 4. This is 4 legs. We could do multi-leg strategies, quadruple leg strategies, all that kind of stuff, and you're going to be spending a ton of money on commissions. And that goes back to saying, what platform are you using? What are you actually doing there? And when you do this kind of stuff, it's just kind of like, all right, maybe you should sit back for a second and really think about what are you trying to capture. What are you trying to really capture in trading options? Are you trying to make some money in options, or are you trying to put on some fancy things and say that you did? All right, just try to come to a realization for yourself. How much money can you really make from an iron butterfly option strategy? Yes, it's going to lower your blood pressure a little bit, but this might take freaking 1 entire week for you to be able to make money from this. Okay, that's a huge misperception. Okay, especially with the advent of weekly options. In addition to that, if you guys didn't know, later on in March they're actually coming out with mini options. Okay, mini options allow you to take 10 share positions instead of 100 share positions. All right, so they're going to be priced down even lower, which mitigates even more risk for you guys. Okay, and this is just to get the flow into options, guys. And a lot of times, a lot of people say that the markets are so compressed now, you can't make the money like you did in the 90s. Equities are dead. In general, we've noticed some of those things, and we've noticed that playing equities is there's a maximum amount of money that you can make from it. And playing these strategies like the iron butterfly, these are also outdated as well. Okay, you can go look at trading options for dummies, and there's it's not really going to do you that much good. How much can you actually execute on some trade like this? Does your broker even allow multi-leg strategies? No, probably not. For a lot of the smaller guys in here that have less than 25K or 40K, you guys probably can't execute a lot of these strategies. The ones that can, I would recommend learning some tape reading, learning some timing, and learning the inherent nature of weekly options and understanding how to trade those to better make use of your money. I'd rather not put $80,000 on an iron butterfly, and I'd rather put $10,000 on a weekly long and make that money, or just go into a simple spread and like we're doing now, we're shorting a lot of put spreads to capture some of this choppy movement, and that goes into talking about everybody thinks that options are only playable during volatile times because that's the only way you can really capture a lot of this stuff. CH Rid, I know you're in here somewhere. I know you're talking about how this market was pretty crappy today, and in general, yes, it moved like molasses for a little bit today. It's been moving like molasses for a long while, okay? And what you need to understand is, like, this is something that we went over last week, especially in our chat room, is that you can take advantage of no movement. Okay, you can take advantage of the fact that this thing's flatlined, okay, especially on Fridays, all right? I don't want to go too much into the details of it, but there are strategies and options where you can take advantage of the mere fact that your stock doesn't move at all, okay? The big guys out there, let me tell you something, guys. Markets in general are, I would say, on the better side of 50% in consolidation and in chop, all right? Depending on what time frames you're in, are really going to determine, how long you're in chop mode or what you consider consolidation. When you're in consolidation, this is when the big money makes money, all right? Because everybody on the street is trying to make some money on, longing, Bank of America. Every single time it's tried to get out from 12 bucks, all right? How many times did you guys try buying this? How many times did you try, all right? And that 12 call probably had huge open interest over and over and over again, only to expire worthless. And today was the actual move. How do you make money on these days when there's nothing happening? All right, there's a lot of strategies for it. There's one called time decay. There's one called shorting volatility. These are all things, again, we teach in our class, but that's just another misperception that we must address with you guys, that you don't always have to go long these things. Okay, you don't always have to chase after big alpha moves like we have today. It's the sexiest, but it's not necessarily the only way to make money. All right. Another thing to realize is that even though you guys have high commissions with options, that's just inherently what happens with it. Okay, you just think about it from exposure-wise. If you're trading 1 share versus 100 shares, you would usually be paying more for 100 shares than 1. Okay, it's the same thing with options. Options are inherently have more value to them, so the transacting of that option is going to cost more. Unfortunately, a lot of times there are ginormous fees that come along with it. What is it, like $9.99 right now per ticket, plus like 50 cents or 60 cents or even $1.25 per option contracts traded. And yes, that does inhibit the fact that it does sort of turn you off from actually trading options. But what you need to understand is that the returns are better. Okay, if your capability of reading the tape and your capability of actually employing successful methodologies is good, you can overcome those relatively easily. Okay.
Yeah, let me chime in on that, Pete.
Sure, go for it.
So, guys, back in 2009, when I had my explosive bank trades, I paid close to $500,000 in commissions. Believe it or not, I know most of you are gonna probably throw up or write about in convulsions when you hear that. But yes, I paid close to $500,000 in 2009 for options commissions. Okay, I was at Fidelity and I was paying, I think it was like $8 a trade and 75 cents a contract. That's not including all your pass-throughs, guys. You guys don't even know what your pass-throughs are because none of you guys look at your trade confirmations anyway. So you got SEC fees, you got exchange fees, depending on what route they send it to. I mean, you got fees up your ass, literally. Okay, so but what Pete was saying about the leverage, if I have at that point, I mean, one of my biggest trades was, let's say, 65,000 contracts in a Citigroup call. You take 65,000 contracts, multiply that by 100, that's 6.5 million shares that you have exposure to. Okay, now you keep doing the math. You got 6.5 million shares of a stock that's worth $3. You do the math, and you got about $20 million. Now, I don't know about you, but I don't have $20 million. I did not have $20 million, and therefore I couldn't just buy 6.5 million shares of Citigroup. But what I could do was pay $250,000 to get the same leverage and to get almost the same returns. Obviously, I'm risking $250,000, but you look at it relatively, And it makes a lot of sense. So having to pay those extra commissions, it's just a cost of doing business, guys. I still made the money, even though I was paying 75 cents a contract. And again, another thing that we talk about in our classes and all that kind of stuff is how to get you guys cheaper commissions. So again, if that's something that you are interested in, which I'm sure you need to be, email us, Lucci at sayinglucci.com. We have other solutions for you. Instead of paying $1, some of you guys are paying $1.25. I mean, obviously this is a cost of doing business, but damn, that's a pretty expensive cost, and I'm sure you guys do want to cut that down. So definitely do email us.
Definitely. So if you guys have, broker commission questions, feel free to email us. It's Lucci at sayinglucci.com. But overall, guys, we've covered sort of like the main points here, okay? One, don't necessarily believe all the academia you have out there. Don't think that the Black-Scholes and the binomial and, the Farmer-French three-factor model are the only ways that you could really trade or make investments, okay? This is not the case. Trading in general and even swing trading and investments are becoming less and less about fundamentals. Okay, and the problem with that is that fundamentals don't determine what you call market price. Market price is simply determined by supply and demand. All right, guys, and this is one thing you have to understand here.
Hey guys, this is Charlie jumping in again, just because I love this story. So Pete and Lucci were talking about how academia doesn't really apply to really trading. So Black and Scholes, that's the famous options pricing formula that was invented by or discovered by two professors. One of them, I think it was Black, was a partner at the hedge fund Long-Term Capital Management, which has gone down in history as the biggest hedge fund blow-up in the history of finance. It took every major bank and the Federal Reserve to come together in an emergency meeting to stop them from taking down the entire U.S. economy. So if an academic like that, who came up supposedly with the formula for pricing options, can create that kind of damage, I think it kind of goes to show that it's not all about what happens in the classroom.
And guys, we're getting a lot of questions on are we solely basing our trades on tape reading? And I would say 90 to 95% of the trades are based on actual tape reading. Okay, the rest of it is some market sentiment, a very small tad of charting. But again, guys, it's all about the tape. I know that everybody's talking about the advent of HFTs, which, guys, just put another plug in here. Check out Chaim's book, Chaim Bodek. All right, check out his book, The Problem with HFTs. All right, the structural issues that everybody should understand and realize are inherently problems with the market that we have right now. But instead upon that, these are microstructure issues. These are things that human beings can actually adjust to. Okay, even though we might see an extremely messy tape, that you can make sense of it. There's actually sense that you can make out of it. And this still allows for generally large alpha moves that you can trade through options. And that's the big thing here, guys, that you have to be able to trade what you see and be able to understand how to trade options and not to be misled by 95% of the vernacular out there, 95% of the literature out there. Don't worry, okay? There is a place for this. Hopefully you guys can find it on MarketFi. Hopefully, guys, you can see it with us. If anybody has any questions about, checking out our classes, checking out the chat, we're always here as a resource, okay? We want to bring, like Charlie said, we manage a fund here, but the main thing is we started from scratch. Lucci started from scratch. I started from scratch. This whole entire thing is from the bottom up, guys, and it's really important to us that we bring this knowledge to the masses because it's time to bring the game back to the retail traders. So just to wrap it up, we're going to go ahead and talk a little bit about some of the let's see, some of the questions we have in here. So options trader in New Jersey, you've been pretty talkative today. Let's see, I was told once I passed my 56, you guys had a trade board that we can work from. I was hoping to just learn from you guys there. Yes, you can actually do that. So you can definitely go and pass your 56. We can sponsor you for it. There is a registration fee, but once you pass it, you can trade with us with some leverage, awesome rates, direct market access, all that kind of stuff. You can definitely do that. I haven't been in your chat yet. Are you guys in the chat, and do you guys give opinion about the tape? Yes, Vitka. So what you can do is you can actually go to sayinglucci.marketfi.com, And there's a trial chat that you can have right now, and you can definitely scope that out. What was the HFT book? The HFT book is called The Problem with HFT. So if you go to marketfi.com, you can actually, it's the first one on the queue by Chaim Bodek himself.
We'll put that link in the chat, guys. I'm getting it up for you right now.
Yeah, so...
Great question. Where'd it go? This thing.
What are you doing, Charlie?
You guys good over there? You want me to get some of these questions?
How do you handle order spoofing, fake bids, HFT, etc.? Tim, in general, again, you have to adjust. You have to be in the trade long enough and understand what's spoofing and what's real HFT and what's not real HFT and what's real buying and not, and pay attention to how the price action is. Lucci can tell you, and we can attest, that we have been screwed multiple times by HFTs, but, you know, we make adjustments. HFTs have a particular behavior. HFTs, you know, are not rebooted every single day with new algorithms. Okay, they take some time to overhaul, and you can actually be able to make trades and make money from it. Okay.
We game the HFT. We are trying to game the HFT. We try to understand what the HFT is doing on the tape, or what some of the smart money is doing, or what some of the big institutions are doing. And we try to play that. We try to play that against them.
So there are ways, especially in options, that if we trade as groups and trade with a little bit of size, like Lucci loves to do, that you can actually move these market makers out of the way. You can move some of these HFTs out of the way.
And guys, sorry to cut Peter off again, but this is something that, you know, we have talked to Chaim Bodek about this. We've studied his book. You know, he was with us last week in our offices, and it's one of the reasons why we've integrated this into our classes, because it's really important to understand how the market is structured, how your orders work. Lucci knew that a lot of this stuff was going on. Lucci and Pete could see that there were certain types of manipulation. They could just feel that something wasn't right, but they didn't know exactly what it was until they read that book, The Problem of HFT by Chaim Bodek. And now that's stuff that we integrate into the class. So this is good information for you guys to look up.
All right, guys. So that seems to be the majority of it. I know that Charlie's been answering a lot of questions. Again, guys, feel free to check out the website. Feel free to check out all the stuff that we have. We want to make sure that you guys have pretty much all the resources at your hands here. Okay, we want to make sure that you guys are capable of, you know, understanding all the stuff. So again, check it out, marketfi.com/products, St. Lucci Options Training. You could go to marketfi.com, find us on there, or go to stlucci.marketfi.com. All right. We're there also. Feel free to email us, lucci@stlucci.com. We're all around here, guys. Let's see, Ryan Nelson. Do you feel like bigger money is on a 2 to 3 day time frame? Ryan, that's a good question. It really depends on what they're trying to do. Let's see. Yes, and Dark Pools. Chris Viles read Dark Pools. Dark Pools is a great book too, guys. You should check that out. Okay, guys. Well, without further ado, really appreciate you guys coming in here. And again, feel free to email us. Lucci, you want to give thanks to these guys? Make a shout out to some people or something?
What's up, guys? Thank you, everybody, for coming. And again, you guys have crazy questions. A lot of these questions are on tape and all that kind of stuff. I mean, again, webinars about options misconception here. We'll get to you once we do, you know, some of the tape reading stuff. But again, you guys are free to email us, you know, about any of these things. And of course, you know, we do have our class, and that's where you can learn a majority of this, or how to put yourself, you know, in the right position to start understanding, you know, how all this stuff works.
Make sure to tweet us, guys. We're on Twitter all the time. I know we might be a little crass there, but you know, we do talk about our trades. We do post our P&Ls. You add us on Facebook, you will see our P&Ls almost every day, and so we're the real deal, guys. You know, we're just traders here. We're normal people. You guys can do this too. You know, this is
and one more thing here. Julian has a good question here. I want to just throw it out there. Julian's saying, do you guys have any option pricing models that you use? And to that, Julian, we have the St. Lucci pricing model, my friend. We have the common sense approach. We use things like perception on how, you know, these things move correlated to the stock. We do not use your options vol. We do not use your deltas. We don't use your gammas. We don't use your thetas. All that stuff, yes, makes sense from a technical perspective. But when you're looking at some of these weeklies and when you're looking to play some of these things intraday, you need a quicker pricing model that it's just more common sense. So when you take a look at an option, we show you how to just look at an option and say, okay, you know what, this is cheap, this is expensive, I'm going to go ahead and buy this because I think I can sell it here if the stock does X, Y, and Z. That's it. So when you take a look at an option, you need to be immediately able to assess if it's a good trade for you or not. That's the way we teach it. And that's the way we preach it, man.
Zach is asking about, real quick, $9.95 commissions plus dollar per contract. That's bad. That's bad commission.
Zach,
So guys, just to give
Zach,
you a heads up, we start everybody off at 55 cents per contract. No ticket fees, nothing like that, and then we lower you from there. We've got some guys trading all the way down to 35 cents. So guys, again, those questions, feel free to shoot us an email, lucci@sayinglucci.com. Thanks for coming along. We'll be following up with all the questions and also with any other inquiries, just shortly after this. Thanks, guys.
Email us about payment plan, guys.
Yes. Talk to you later, guys.
Have a good night.